benefited from the strengths which India has shown over last 2 decades. So consumption story, it will continue. The only difference will be, which sectors, which themes India consumes. But the consumption, general consumption from the public at large will continue. You will have a continued capex story. Now, capex is a very wide term, but if I have to say, over last 7 8 years, government has been a major participant in the capex or the capital creation of the country, and that will continue for another a decade at least. There will be different priorities that the governments assume over a period of time. So, like city connectivity, intercity connectivity, ports, roads, railways, which had been a larger stress area of our government. I think the next decade will belong to intra-city mobility, and you will see lots of spending, lots of GDP growth coming from there. So yes, I think I see this not only for next 1 decade, but at least for 2 3 decades. This is a sustainable story, especially if I put it on back of government policies and market with 2047 Viksit Bharat plan. It looks like a very achievable, very sustainable plan, which has milestones and policies and procedures and structures surrounding it. So I'm not unsure about it. I'm not too concerned about any sigma event that might rise, given that India has withstood sigma events in the past. So very positive, very optimistic on Indian growth story, and for all practical purposes, is a very sustainable story.
Wonderful. What we've seen, Akhil, is the currency. India has been the rupee has been the worst performing currency globally,
Correct.
almost down 6%.
Correct.
As much as last week, it was close to 1%.
Correct.
So, in spite of such good macros, why is the currency the worst performing currency, and how do you see that panning out for in times to come?
Okay. So I got your question.
Sure. Yeah.
Okay.
Yeah.
So so there are 2 3 things which happened as far as INR is concerned. Number one, we continue to, since September onwards, we continue to remain under stress because of tariff wars, and US putting more tariffs on India, and we saw sustained outflows from our capital markets, which resulted in 2 things. Number one, we did not get anticipated organic flows from our trade, and number two, continued outflows meant that India's position, if we are a net import country, right? So India's position on currency continued to remain stretched. The general philosophy or the general tendency of central banks is either an intervention to smoothen the move or to find a level of currency, which is called active intervention. Now RBI has clearly stated that they do not have an intended level of currency in their mind, and they intervene only to smoothen the extra volatility. So the factors that led to were more of global flow rather than any organic thing. Uh, in a way, RBI also allowed rupee to find its new level, so that our exports become slightly more competitive. And given that our crude basket, a large import basket, was always over last 3 years has been very well diversified. So I don't think RBI was too concerned about dollar or rupee depreciating significantly against dollar. Also, what happened in the course was we replaced a significant part of our foreign currency assets, that's FCA, away from dollar towards gold, in line with many other central banks globally, which meant that while INR is depreciating, your FCA's holding of gold also appreciates. So, nutshell, we did not see we did see some extra volatility, but this is not on account of any fundamental weakness in the economy. This was more on account of flows and forward dollar trades. Believe me, ND OIS paying happening in forward trades led to currency sell-off. Mostly looks like a, one-off phenomena. The moment you see RBI coming with a greater amount of dollar swaps forwards, you will see this move ebbing down, and INR should stabilize very soon. One thing which one will have to keep in mind is relatively we are better or more reasonable today. You know, we are closer to REER in terms of our competitiveness. It helps exports. So any further weakening from here, there has to be a fundamental weakness in the economy, which I don't see currently. So in a way, it was slightly surprising given that we had managed 2023 and 24 very tightly, but it's a welcome, reevaluation, if I have to put that word.
Sure,
Mm.
sure. In the recent RBI policy, Akhil, we've seen RBI cut rates,
Correct.
and of course, we've not seen that translates into the yield curve. If you see longer dated yield curves, they've moved up rather
Correct.
than down
Correct.
in terms of how the yields are.
Correct.
So, how do you see that panning out, and how would government enforce that? This rate cut which RBI has done over the last 1 year gets transmitted to its clients in terms of lower interest rates. That was one part of the question, and I will ask the second part once you answer the first part.
Okay. Um, okay. So MPC is purely a target-oriented, counter-cyclical job. Right? If the inflation goes up, they will hike the rates. If the inflation goes down, they'll cut the rates. Now, to the extent of rate cuts, I think the commentary which came in June and the commentary which came in December rate cut did not give enough support or evidence that this cycle is deep. So basically mean that it's a shallow cycle and it's coming to an end soon. So last 75 basis of rate cut hasn't had any impact on yields because markets always discount the future. And if you tell me there are no future rate cuts, I will not buy a risk. Um, Two other things which happened concurrently. Number one was ever since June, July, the demand supply of longer dated papers. There were two, three things which continued. Number one, government changed the NPS and the PF rules to have a greater allocation towards equity, which meant that incrementally most of the long PF money, NPS money was going into equity and not actually into fixed income or buying long dated G6, which is eventually the end point. Secondly, in 2023, insurers, NPS, and all they had gone to government asking a greater share of longer dated papers because their collections insurance premiums were higher and they wanted longer dated assets. Now, come 2020, FY25 and FY26, the premium collections actually went down significantly on account of changes in taxation, and hence the demand reduced. So, in second half of the year, the government again tinkered the calendar, but the thing was, the holders were already laden with huge amounts of stocks. So my sense, even pre-policy, was that till the time RBI clears stock and duration, both from the markets will continue to reel under, higher amount of supply and lower amount of demand. RBI has declared 1 lakh crore of OMO in the month of December. I anticipate 2 lakh crores more of OMO coming in Q4, and that is when your yields will start coming down. Now, in the process, what will happen is your yield curve will remain steepened because liquidity is easy. So your near end of the curve will continue to stay near SDF rate or reverse repo as we knew it previously. And longer dated GSEC will continue to have a forward looking approach. So you will have a slightly steepened yield curve, but that said, overall yield curve will shift downwards, but that will take 2 3 months. If one has risk appetite, I think longer end of the yield curve is very cheap. At a country which inflates at forward-looking 4% or sub 4%, moving in from fourth largest economy to the third largest economy with sustainable fiscal deficits, sustainable growth. I think this is as cheap as you get. You won't find these interest levels again 5 years down the line.
Perfect. So I think you alluded to my next question.
Yeah.
So when the treasury teams are allocating money, and
Mhm.
suppose let's assume that they have a tenure of over 1 year, if we
Sure.
were to look at it,
Hmm.
percentage of allocation would they look at deploying in the longer end of the yield curves? Why I'm asking this question is, of course, it has been volatile, and
Hmm.
most companies being listed, they, their board presentations reflect quarterly returns and so on and so forth. So ability to take volatility is not
Correct.
very high
Correct.
in
Correct. Correct.
most corporates.
Yeah.
Of course, some people have the flexibility, some do not.
Correct.
They want a very largely a more
A
predictable
stable
outcome.
kind of a flow. Yeah.
Yes, but given the scenario, and like you
Hmm.
said, that longer end of the yield curve sounds is really
Cheap.
attractive at this point.
Correct.
What kind of allocation would you recommend on the longer end of the yield curve for treasuries?
For treasuries which have a little bit of risk appetite, they can go from 10% to 20% at longer end. Remaining, I think what is important is you have to ladder up your risk. Okay, so there are two. When you say risk, how do you position risk in and match products accordingly? You are in a easing cycle. Your repo rate is 5 quarter. Liquidity is positive. RBI has committed to keep liquidity positive to the extent of 1% of NDTL, which means close to 2.5 lakh crores sustainable permanent positive liquidity in the system, which means your operating rate of the economy overnight will be close to 5%. Now, this is a given unless and until there is a sigma event or a unnatural hike in inflation, which then forces MPC to hike rates, which is not in visibility at least for next 2 years to me. So till such time your operating rate remains 5 or sub 5. Now, in this environment, when you don't see a price risk of rate hike, it is important to ladder up your risk to get slightly additional returns. Otherwise, you will be stuck at very low end, right? So if you're a liquid player, you go into ultra category, which is up to 1 year category. If you're a 1 year category player, you risk up to 2 year, 3 year category. And if you're a 3 to 4 year category, you go 10 to 20% on the longer end of the curve, that is GSEC. Increase your allocation to 2 3 year or 5 year if that is comfortable, and reduce your delta or layout at below 1 year. Yield curve is very steep, so even the accrual difference is pretty steep. Just to give you an example, a gilt fund, a pure play gilt fund today is the highest YTM product within the yield curve. Now this happens rarely. And secondly, if I have to say difference between, let's say, a 2 3 year duration product and a 6 months duration product, again the YTM difference is 50 basis or above. Till such time you don't have liquidity risk or rate hike risk, this is to be taken. So it's imperative that you scale up your risk to the extent that volatility that you can withstand. But if you say quarter on quarter rolling return basis, it's difficult to go wrong from here. So it's advisable to get that extra 50 bips as long as, or 100 bips as long as the central bank is giving you. This is more or like a put option on a central bank rather than taking risk yourself.
Sure. So, one other question, given that we have the benefit of your wisdom over the years, what are the key risk factors which the treasury teams and CFOs should look out for as lead indicators in terms of cycle changing or hugging more to predictability in some sense? What are the key points which would be, acting as a trigger to say go back to safety or take risks, more risks, and so on and so forth?
Okay, so there are two facets to it. Number one, a forward-looking thing, and second is the current environment that you're playing in, right? So in money management, it's simple that you don't swim against the tide. Number one, right? So for treasuries, for example, when I was managing a couple of treasuries long back, the first and the foremost thing was liquidity. As long as there is predictable liquidity, both from operations and from financing angle, uh, as long as it's predictable and you think it's going to stay easy and you're not going to face any hiccup in your operations, in that backdrop, assuming your operational cash flow is consistent and secular and predictable, the systemic liquidity, as long as you see it positive, or you see it changing, that defines largely your largest quantum of treasury investments, right? So if you see liquidity going tighter over a period, you will of course reduce your outlay at duration and bring in more at overnight or close to overnight level, such that your business doesn't suffer or you do not incur MTM losses. Tight liquidity anyways means your financing cost will be higher, so your EBITDAs will become lower. On top of a lower EBITDA, you don't want treasury losses. Right. So liquidity should always and always be the number one guiding principle for treasury investments. When I say liquidity, it is both predictability of your own cash flow and predictability of what a central bank intends to maintain. And central banks generally give a very clear sense of liquidity. So if you say Jan 2025 onwards till now, in fact, December 24 onwards till now, RBI has clearly said they are going to maintain easy liquidity, and each and every step, incremental step, has only and only gone towards it. So, if you have to ask, what is your outlook on liquidity? I think outlook on liquidity is next year and a half or 2 years. You are going to be in an easy liquidity scenario. Secondly, most important is while we decipher or we try to forecast the rates, the future rate direction, one has to look at prices. So I like telling in my oratory that it is not the rate hikes or rate cuts that make or lose money. It is what was priced in at rate hike and what was priced in at rate cut on which you make money, right? So for corporate treasures, the idea should be simple. Assuming you have predictable cash flow and money which can stay for 3 to 6 months, one should always look at buying cheap and selling expensive, right? Flows will force you to act in a secular manner where most of the money is going or most of the money is coming out. But remember, that is mostly MTM in nature.
Perfect. Perfect.
So if you have to go back to April and say, let me buy highest risk, and you were correct that June rate cut did happen 50 basis points, but you actually incurred losses. And similarly, if you go back to 2023 and say, everything is going down and let me withdraw everything, if you had not withdrawn, you would have made money. So pricing of the next direction is important, but underlying has to be liquidity.
Sure. So I think, Akhil, we all know you represents one of the most pristine institutions in the country, Tata Group. Anything which comes out in your mind where you would want to talk about Tata Mutual Fund and some of the products which you think merit consideration for corporate side, I would want you to spend a couple of minutes there.
Sure. So yes, it's a privilege to work with Tatas, and the philosophy of the group always has been community first. To that extent, not doing anything wrong and correct ethics and morals being imbibed in all the functions that we do is goes unsaid. We do not take overtly risks, or we do not tend to overpromise under deliver. We want to act more like a predictable secular asset manager. Within the bouquet of products, we have almost all the products that matter, or largely SEBI has commoditized products for mutual funds now. Almost all of them are similar, right? So we have all the products. Given the current environment and how I see yields panning out, I think our ultra category, which is our money market, low duration ultra, whichever of the three products suits, they have performed excellent, and I think they should continue to perform excellent over the period of next 6 months, 1 year, 2 year. Our money market fund is the largest in the industry. It's north of 40,000 crores. Our low duration, that is treasury advantage, is a blue-blooded, pure play AAA, highest credit safety portfolio, and which means slightly lower accrual. But if you see the performance of the product, again, it has done relatively well. So we have a bouquet of products which suits everybody, bases their risk appetite. Somebody who can hold on money for more than, cross this financial year, 6 months, 1 year, I would urge to look at our corporate bond fund and gilt fund. They have also done very well. We will not do anything which is very unpredictable or taking a risk beyond what is advised in a portfolio or in an environment. Yes, given that we are asset managers, so there will be market volatility which affects everybody. But beyond that, we try to make things very simpler. So if you ask me, I divide product bouquet into three ranges: up to 1 year, then secular stable returns, which is 1 to 3 year, and then alpha seeking products, which is more than 3 years. Right. Within alpha seeking, gilt and corporate bond, depending upon your risk appetite. Within secular stable, we have a short term fund, which is doing pretty well. And up to 1 year, you can choose between low duration money market. Both are doing very well. Even Ultra is doing very well. So, any of the three products. Simpler,
Sure.
not giving a very wide range of things, but simpler.
Sure.
Yeah.
Perfect. Last question for me, for you, Akhil. Before I would ask our team to present some stuff which we do
Sure.
on mutual funds and bonds, and then open up for questions.
Sure.
Um, so, what's your view on income plus arbitrage as a category? Because if you're, of course, it has corporate bond funds as
Sure.
one of the components going in. But in a scenario, if you can get 70 basis points extra on account of taxation advantage, if you have a 2 year holding period, do you see that category expanding quite a bit in times to come? Because I've seen treasuries, some of the treasuries almost going up to 25-30% in that category, where they know that, at least we will have, say, 50, 100 crores always for liquidity perspective in that sense.
Okay. So let me put this in mathematical terms. Arbitrage allocation putting at around 30, 35, 35, 40%. And arbitrage generally over a period of 3 months rollings gives you returns about repo plus minus 25 basis points, right? So let's assume repo as a return for next 1 year, and assume that rate there are no further rate cuts. So 35% of your portfolio, 40% of your portfolio makes five half, that is 2.2% absolute, and let's say remaining 60% of your portfolio makes 7%, that is 4.2. So in totality you are making 6.4% return, all right, on a gross basis. Now post that, let's assume you held for 2 years, and you incurred what, 12.5% taxation post.
Yeah,
Yes.
40%
Yeah,
after all
14,
services.
14%.
40.
So you lose another around 75 basis points there,
Yeah,
72, 73 basis points. So you end up making 575, kind of a five half to 575 post-tax return in income plus arbitrage, which is about 50 basis higher than arbitrage fund.
that's right.
Right, that's right. And if I have to pure play, then compare it with, let's say, a corporate bond only allocation, which assuming gives the same 7% return, and you incur a 25% taxation there, which is again around 530-ish, right? So you will get additional 40 to 50 basis points of return, assuming no price movement. But if the price movement does happen, then the only question one has to ask is 50 basis good enough consideration to lock in your money for 2 years? And the as I said, it's individual or a very clear thought process that I will not need this money for 2 years. Then you have to judge products accordingly. Your asset allocation has to be accordingly done, such that there could be other assets which probably have a better risk reward or a similar risk reward. So income plus arbitrage, it's a good category. The only thing is, if you see last 6 months, 1 year, when most of the money has come in the category has the performance has been mixed bag. That's because the yields acted strange and funny, and which if it has to continue, then you will still end up making returns closer to arbitrage funds. So I think entry in that makes more of an effect. Secondly, judge the underlying, whether your underlying is the underlying, and when I say underlying, it means the 60 to 65% allocation that is corporate bond or short term, whichever category is there as underlying. What kind of a accrual is happening there? So if the accrual is good, so you can have as big as 25 bips gap between two corporate bond funds also. All right. So choose something which has better accruals. So this category, as of now, starting now, I'm kind of neutral to slightly bullish. So yes, an allocation can be looked at, but then entry point has to be very, very correct there.
Perfect.
Yeah.
Perfect. Thanks, Akhil. I will request you to stay on if there are any
Sure.
questions when we
Sure.
open it up. I will
Sure.
request my colleague Danish and Aman to present quickly our proposition on the mutual fund side and the bond side.
Yeah, hi. Good morning, everyone. Thank you, Saurabh, for the same. So I will start the presentation on the receiver metrics, which we prepare and showcase to all our clients. Hope my screen is visible.
Yes, Danish, it
Yeah,
is.
perfect. So the this receiver matrix is our internal proportion which we prepare and send it to our clients basis on the all risk parameters and the return parameters which we consider. Coming to the parameters which we consider are the qualitative as well as quantitative. In quantitative, we consider all the risk parameters, its portfolio, its allocation, its weightages. Performance may be consider the consistency also along with the performance and the time period returns. Qualitative may what we do, we actually consider the MC pedigree, the track record of the fund manager, the investment style of the fund manager, the risk associated with the team, and so on. So coming with the, I will just take you to the couple of the categories so that you will have the best arrangement of what we do. So coming to the first one is the liquid fund category. Uh, Here actually all the risk parameters have been considered like credit risk, stress sector, sensitive issuers, interest rate, and so on. So in credit risk, what exactly we do, like we know liquid funds, money market funds, these funds invest in short-term papers, which are rated A1 plus. Usually the highest rating is the A1 plus of the short-term papers. Now we consider the short-term rating. Along with that, we consider the long-term rating as well, long-term rating of the issuers, whether the issuer rating is triple A, double A, double A plus, and so on. If the long-term rating is triple A and short-term is A1 plus, then we give a high score to the funds. If the long-term rating is less than double A, maybe double A plus or sorry, less than triple A, which is double A plus or double A minus, then we give the low score to those funds. Like in this case, Aditya Birla Liquid Fund, the score is less, which is one as compared to the others, which means this fund manager invests in the CPs and CDs whose short-term ratings are A1 plus, but at the same time, the long-term ratings might be double A minus, and so on. And the highest score to the fund is the Bandhan Liquid Fund, which is 10, which means the fund manager invests only in the short-term papers which are rated or which have the long-term rating of AAA only. By doing this, we consider the scores of a credit risk, and then we give the scoring to all the funds in the particular category. Coming with the next is stress sector. Internally, we have classified some sectors into stress. So the fund manager, if they take the exposure towards those funds, then we will give the low scoring to those funds. Sensitive issuers, interest rate risk, these all are the risk parameters which we consider at the time of evaluating the funds. And then we do the ranking of the fund, ranking on based of risk. So if the investor, if a corporate treasury is a conservative kind of risk profile, and they don't want to take any kind of risk, if they want to purely play into the triple A only, then the high scoring funds in this column like Mirai Asset, Bandhan funds and so on, these funds can be looked at. Coming to the second side of the coin, which is the performance, we consider the YTM. YTM here is the net or YTM of the fund, composite performance like 1 month, 2 month, 3 months, 6 months returns, and the consistency ratio of the fund. Consistency means we what we do, we consider the last 12 months performance on month-on-month basis, and we see whether the fund manager has outperformed the entire category on month-on-month basis or not. If the fund manager has outperformed in all 12 months, then we'll give the high score to the funds. If the fund manager has not outperformed the entire category, then we would give the low score towards the funds. So this is one of the parameters which we consider in the returns. And based on all the three parameters, then we give the ranking to the funds based on returns. Like in this case, the highest score comes to the the highest rank, first rank comes to the Birla and Union and so on, which means these are the top funds based on the returns. Now, clubbing both risk as well as returns, then we give the overall scoring to the funds and the overall ranking to the funds. So these are the top funds which we would like to recommend to our treasury investors based on both risk as well as the returns. We do this for all the categories, whether liquid, ultra short term, money market fund, and corporate bond funds, and all types of funds we consider doing the ranking. So yeah, these were from my side. One, you can then take it over.
Yeah, hi, good morning, everyone. I'll just put up my screen.
Just to summarize, what Danish said is, we run this proprietary methodology to evaluate risks as well as returns, giving more focus on the risk and returns and consistency of returns. We do this across mutual fund categories so that we can, present this to our corporate treasury clients on a fortnightly basis. This gets updated on a fortnightly basis. Now I'll request Aman to take us through our corporate bond proposition. And
Perfect. Hi, good morning, everyone. So is my screen visible?
yes, fully visible now.
Perfect. All right. So we at CorpCare, we run a very active bond desk. In fact, one of the very few people in the industry or players in the industry who have an advisory desk for bonds. There are certain differentiations that we have, where we call ourselves a little different in this space. Certain USPs that we have to our advantage. One of the main being, we are a one-stop destination when it comes to all treasury requirements on the fixed income side. Danish already discussed mutual funds. If there are clients who are looking at NCDs, if they're looking at CPs, they're looking at FDs, everything gets covered under one umbrella for us. Second, we believe in a very transparent pricing model wherein there is zero brokerages which is charged. There's no transaction fee, there's no management fee of that sort. Even in cases where we've kind of, created specific curated portfolios for a client, there'll be no management fees that have been charged on that. Third, considering we have a RI license from SEBI, the idea is we kind of make sure that whatever recommendation that goes from our side is agnostic in terms of being mutual funds or bonds, considering we have expertise on both the sides. Fourth is all the transactions that we do for our clients, everything is exchange based, and there is a single KYC which kind of helps clients to do investments on all sorts of investments under one KYC documentation. Fourth is we have a state-of-the-art platform wherein clients can directly do investments and monitor the investments, most importantly on the mutual fund as well as on the bond side. In terms of our offering, this is, for example, if clients are looking at as low as 15 days to all the way up to 6 years, 7 years, 10 years, we are across the curve. In terms of the yield criteria, if somebody is looking at somewhere around, let's say, 6 to 7%, let's say AAA rated, very high quality papers, to all the way up to high yielding bonds, everything gets covered in bond offering, which rightly said starts from 15 days or goes all the way up to 8 to 10 years. These are certain opportunities that we've culled out and we wanted to showcase. where we've seen some very interesting investments opportunities. For example, if you could see, Mirai has been doing 3 month CPs at somewhere around very closer to 7%. Some very premium names and very high quality names. For example, Barclays, HSBC, they've done some 6 months investments, CPs at somewhere around 7%. A lot of our clients have kind of taken interest in such sort of investment opportunities. Also, what we've seen is a lot of our clients are also moving some part of their liquid portfolios to CPs. Rightly so. Obviously, there is a catch to this. Reason being, it's not as liquid as what a mutual fund portfolio would be. But obviously, with the caveat of having a buy and hold strategy, we've seen certain clients moving some part of their allocation from liquids to CPs, because rightly it offers a spread of almost 120 basis point. What we're trying to showcase here is we've shown a CP offering and we've shown a mutual fund offering. We're showing that a mutual fund offering could fetch you, so let's say somewhere around 6%. Obviously, it's a lot more liquid portfolio. Similarly, if a CP portfolio were to be created and showcased, it could easily offer a spread of almost 150, 120 basis points. So this is on the CP bit. We also have some very interesting bond quotes on the NCD side. For example, just to highlight a few, we have some very premium names. Let's say, for example, from the Tata Group, for example, for December maturity fetching as high as 680, 690. There's Credila, which was offering somewhere in March at somewhere around 705. So very interesting opportunities in senior secured sort of instruments wherein clients have invested at some very interesting levels. Similarly, if clients are looking to build in some duration in the portfolios, we also cater to all sorts of requirements, let's say in the AAA category, all the way from PSUs up to private, 8 years, 10 years, if somebody is wanting to build in duration at some very attractive level, which is being showcased here. Similarly, we have a lot of offerings outside of AAA, for a more risk reward adjusted sort of returns, wherein if clients are looking at AA plus, AA sort of investment opportunities, these are certain names that we've showcased. These are certain opportunities on the AA managed side. Most importantly, what we also offer is, unlike a lot of other wealth houses, we are also very active on the fixed deposit offerings. If clients are looking at anything, from PSU names or some larger NBFCs or to some securities company, we have been, quite active in structuring ICDs for our clients, which can offer them a good spread of almost 100 basis point over and what they would get in a bank FD. So as long as the structure remains broadly the same, it's a corporate deposit, other than a similar structure that you would run in a bank, with an NBFC or a securities company, which can offer you a good spread. So this is how we've kind of showcased our offerings on the bond side.
Perfect. Perfect.
Saurabh,
Very nice. Thanks so much. Are there any questions from the group on anything?
Saurabh, can I just add a couple of bits on the market
Sure,
slightly?
sure, sure.
Okay,
Go ahead.
so India Inc. as a whole is at the lowest leverage point over last 12 years. The upgrade downgrade ratio is at the best in last 12 years. So why I'm mentioning these two things is because these show the credit health of companies, right? So if the credit health is improving and drastic and you're at lowest leverage point, it is difficult to go wrong. So your credit risk parameter, then the score that you give to credit risk, will reduce, which means your clients can actually look at some of the offerings like you showed, the better names with better yields. So the imbibed risk within them currently is probably at the lowest in last decade. So going in with decent names, decent accruals might be the right way forward. Just to give you a couple of names as example, um, if you see last 5 years, something like a Adani Power or something like a General Stainless, as simple as those names, which are not into financing business but organic businesses, their ratings have moved up anywhere from triple B plus to double A, which is like a 6-7 notch upgrade in 5 years. And balance sheets are looking much clearer. These are just two names. There are n number of them. So what I wanted to impress upon is the good names, good businesses where you have decent accruals. One should look at those.
Perfect. Thank you, Akhil. Thank you for adding that. Any questions from anyone?
Yeah. Uh, Hi, this is Daniel. Hello, everyone. Uh, so the more brief we got on the investment side, do we also provide any solution related to lending as well?
Sure. Thanks, Daniel. I'll ask my colleague and co-founder, Jitendra, who's on the call, to maybe dwell upon this. Ankit, you'll have to get him in the room for him to speak, Jitendra.
Good, sir.
Okay. Perfect. So, Daniel, I think let me answer your question. So, the thought in our minds is, of course, CorpCare provides a 360-degree solution to our corporate clients. Not only, uh, we provide advisory services, assistance for clients on the wealth management or surplus management, as the case may be, but we also assist clients in terms of right positioning the borrowings, guidance on the borrowings, bringing the cost down. So depending upon the credit, requirement, we assist clients in terms of growth capital, promoter funding, supplier funding, and as I said, it depends upon the credit history, rating, requirements, liquidity of the clients. So one works from all the way, starting with PSUs in low single digits or maybe 7.5% kind of returns, all the way to funds when there are specialized requirements. We do also assist clients in funding for their global needs. Daniel, did that answer your question?
Yes, sir.
Thank you.
Sir,
Any
I have
other
a
question?
question. So,
Yes.
what specifically today we are talking of OEMs. Many of OEMs are exporters and they may also have operations outside India. So, do you all have any proposition or suggestions for OEMs who have operations or export or are into exports to manage liquidity and surplus?
Well, thanks. Thank you, ma'am. I think CorpCare, of course, predominantly a lot of our work happens in India. But for clients where they are engaged in exports, like they have their subsidiaries in Singapore, Dubai, London, or US, we assist them with global treasury management solutions as well, so that we can optimize their returns on the global money which is there. Usually, it is short tenure because the global money either gets used or comes back to India in that terms. But yeah, we've provided good short-term solutions to our clients for global treasury. Ma'am,
Thank you, sir.
any other question from anyone? Okay. Um, Akhil, thank you so much for your time. I think really appreciate you taking out the time, and thanks to all our colleagues here. We look forward to creating this as a program and coming out with capsules with experts like Akhil, who shared from his experience, his thoughts, what is happening in the market, and so on. So really, thanks to everyone who joined in the call, as well as Akhil, who spent his valuable afternoon with us in that bit. Uh, Thank you, everyone. Sorry, we exceeded 5 minutes, so but apologize for that.
Thank you. Thank you, Saurabh. Thank you, corporate team. Thank you, everybody.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you very